In this video, we'll take a look at some financial accounting questions related to journal entries. Now, this video is meant for students in their first accounting class and is a great way to review for their next test. I'm Scott Meister. This is Test Prep Episode 3. Alright, so the first question reads, when Angela Smith, the owner of Smith Co., withdraws cash for personal use, the journal entry should debit Angela Smith drawing and credit Angela Smith capital, debit Angela Smith drawing and credit cash, debit cash and credit Angela Smith drawing, or debit cash and credit Angela Smith capital. So whenever we take money out of the company, we're withdrawing cash. Our company has less cash now than it did before. Cash is an asset. In order to decrease the balance of cash, we need to credit it. So B is the only one that we can select because it's saying we're crediting cash. Here we're debiting cash, and that doesn't make sense because we're not increasing our cash balance. Additionally, we are not increasing our capital balance, and that's what a credit to Angela Smith capital would be. So the correct answer then is going to be debit Angela Smith drawing and credit cash. For question 2, it states a compound journal entry has only one credit and one debit, has two debits, has two credits, affects more than one debit and or more than one credit. Well, a compound journal entry typically just means that you may have more than one debit and or more than one credit. So it would be a journal entry that would say, two debit entries and one credit entry, or one debit entry and two credit entries. That would be an example of a compound journal entry. So it doesn't have to have two debits. It doesn't have to have two credits. It definitely doesn't have only one credit and one debit because that's a simple journal entry. So D is the best answer here, where it says affects more than one debit and or more than one credit. And let me just change this to 1. There we go. Okay, so the next question states, to record services performed for cash, you would debit service revenue and credit cash, debit service revenue and credit accounts receivable, debit accounts receivable and credit cash, debit cash and credit service revenue. So we're looking to record services performed for cash. So the first thing that I look for in any transaction, if it's dealing with cash, is did cash go up or did cash go down? So here we received cash, so I know cash went up. I know cash is an asset. And to increase the balance of an asset, we need to debit that. So I'm looking for any debits with cash. And the only one we have here is D, where it says debit cash and credit service revenue. So we know A is wrong because we're crediting cash, so that's decreasing cash. We know C is wrong because that's a credit to cash as well, decreases cash. So when I look at B, I'm looking at service revenue, and revenue went up. And if it went up, that means that we need to credit it because the normal balance of a revenue account is a credit, so we increase the balance of a revenue account by crediting it. So here, we wouldn't debit service revenue, and it has nothing to do with accounts receivable because we received cash. To journalize the purchase of equipment for $12,000 using a $3,000 cash down payment with the balance due in 15 days, you should debit equipment $12,000 and credit cash for $12,000, debit equipment $12,000, credit cash $3,000, and credit accounts payable $9,000, debit cash $12,000, credit equipment $3,000, and credit accounts payable $9,000, or debit accounts payable $12,000, credit cash $3,000, and credit equipment $9,000. We have a purchase of equipment for $12,000, and so I know that equipment is an asset. We increase the balance of an asset account by debiting it, so we're going to debit equipment, and that's going to be $12,000. And we use cash for the down payment of $3,000, so I'm going to credit my cash. We have less cash now than we did before. We're going to decrease that balance to decrease the balance of an asset. We are going to credit it. So cash, that's $3,000. So we owe the rest, and the rest is going to be the 12 minus the 3 equals 9. So that means we need to credit some type of an account for $9,000. So based on this information, I know A is incorrect because we didn't pay cash at $12,000. And B is going to be our answer because we debit equipment for the $12,000. That's correct. We credit our cash for the $3,000. And we are going to credit accounts payable, that's a liability account. That means we owe money, and that's going to be for the $9,000. So we are going to credit our accounts payable. So let's take a look at item C here. Item C is incorrect because we're not going to debit our cash, and we're not going to credit our equipment. This is wrong. The only thing right in this particular answer is this credit of $9,000. And let's see here for item D, debit accounts payable. Well, that's not true. Credit cash, that was okay. And credit equipment, that's not true. So it looks like it's going to be answer B. So the next problem reads, when a business writes a check for the current month's advertising, the journal entry should debit cash and credit advertising expense, debit advertising expense and credit cash, debit advertising expense and credit accounts payable, debit accounts receivable, and credit advertising expense. So like I mentioned before, whenever I'm doing a cash transaction, I look to see if we increased or decreased cash. So when the question states write a check, that means it's a cash transaction. So I know that if we wrote a check, our cash went down. We have less cash now than we did before. To decrease the balance of a cash account, we are going to credit it. So it wouldn't be a debit to cash, so I'm marking that one off. It's going to be item B here because there's no other cash transactions. So we know that it's credit to cash. We are going to debit our advertising expense. We have more advertising expense now than we did before. So that means it increased. We increased the balance of an expense account by debiting it. So that's why we're going to debit our advertising expense and credit our cash. The next question reads, on June 30th, Jan Co. received a telephone bill for June's phone services. This bill will be paid in July. What is the journal entry for this bill? Debit telephone expense and credit cash, debit cash and credit telephone expense, debit telephone expense and credit accounts payable, debit accounts payable and credit telephone expense. So we've got a telephone bill here, and it says that it's for June's phone services, but it's not going to be paid until July. So that means we're going to put it on the books. We're not going to pay it right away. We're going to pay it later, which means we owe the money. And if we owe the money, that means we haven't touched cash. So I'm going to get rid of any transaction that shows cash and debit cash. And so now we're stuck between C and D. And when we record this telephone bill, we know that we're going to pay it later. When we pay it later, that's a liability. And to increase the balance of a liability, because after we record this bill, we have more liabilities than we did before, we need to credit a liability account. So to increase the liability account, we are going to credit it. If I look between C and D, I'm crediting a telephone expense, so that won't work. Or I'm going to credit accounts payable. Accounts payable is a liability. We increase the balance of accounts payable by crediting it. So that's going to work for us. That'll be answer C. And then what we need to do is figure out what account we're going to debit. Since it's a bill for the telephone, that would be a telephone expense. Telephone expense is an expense account, and we increase the balance of an expense account by debiting it. So item C is the correct answer. The next question states, recording a journal entry for receiving payment from a credit customer on account includes crediting accounts payable, debiting accounts payable, debiting accounts receivable, or crediting accounts receivable. So if we're receiving payment from a credit customer, so this means that basically we extended credit to them when we perform service or when we sold them some type of goods. So what happens is the original transaction is going to be a debit to an account called accounts receivable. Accounts receivable represents money that a customer owes us, and then we would credit something like sales. So now what we have to do is we have to get rid of the accounts receivable, because once they pay us, once we receive the payment, this customer no longer owes us. So if we initially debited accounts receivable, then we need to go ahead now and credit accounts receivable so that their balance is gone because they paid us. We need to look at item D here then. So item D here is going to be the answer, credit accounts receivable. So we wouldn't debit accounts receivable because that means that they would owe us more money. And accounts payable has nothing to do with this transaction because we're dealing with a customer and receiving money from a customer. Accounts payable represents amounts we owe to creditors. So I'm going to cross those out. So the answer there is D. Okay, so the next question states, list which accounts should be debited and which accounts should be credited. Use the accounts listed below. And here we've basically got a chart of accounts, and here's the rest of the chart of accounts. For part A, it says Chad Brown contributed capital to his business. So whenever capital is contributed to a business, we are going to receive cash. Cash is an asset. We increase the balance of cash by debiting it. So we are going to debit our cash. And we are then going to credit Chad Brown Capital. Chad Brown Capital is an owner's equity account. We increase the balance of capital accounts or owner equity accounts by crediting them. So we're going to credit, and I'm just going to put CB Cap for capital. Next it says a credit customer paid on their account. So if a credit customer paid us, that means we received cash. Cash is an asset. We increase the balance of cash by debiting it. So we're going to debit our cash. And if they paid on their account, it means that they owed us before. When we recorded the initial transaction, we debited an asset account called accounts receivable because that account represents money that customers owe us. So since the customer paid, they no longer owe us, so we need to reduce that balance. Accounts receivable is an asset account. We reduce the balance or decrease the balance of accounts receivable by crediting it. So it'll be credit accounts receivable. For item C, it says perform services for cash. So when we perform services for cash, we are going to receive cash. So that's going to be a debit to cash. Again, cash is an asset. We increase the balance of cash by debiting it. We have more cash now than we did before. And when we perform services, based on our chart of accounts, we need to figure out what our revenue account is. And you can see up here we've got service revenue. Service revenue is a revenue account, so our revenue balance after this transaction is higher than it was before. So that means it increased. We increased the balance of a revenue account by crediting it. So I'm going to put credit in service revenue. For item D, it states purchased equipment for cash. Equipment is an asset. Our equipment balance is going to be higher than it was before, so it increased. We increased the balance of that equipment account, that asset account, by debiting it. So we're going to debit equipment. And then for cash, we have less cash now than we did before. We decrease the balance of cash by crediting it. So we're going to credit our cash account. For item E, it states issued a check to Chad Brown for personal use. So when we issue a check, that's another way to say we paid cash. So if we paid cash, we have less cash now than we did before. Cash is an asset. We decrease the balance of an asset by crediting it. So I know I've got a credit here of cash. And then we have to figure out what account we are going to debit. So I'm going to put a debit here. And since we issued the check for Chad Brown for personal use, that is going to be a drawing account. And a drawing account, the normal balance of that is a debit. So we increase the balance of a drawing account by debiting it. So the account balance is higher now than it was before, so that's why we're going to increase that. That's why we're going to debit that account. So I'll just put CB draw. And then for the last question, we've got based on the transactions below, which accounts should be debited and which accounts should be credited. So we've got perform services for $2,000 cash. If we perform services for cash, that means we received cash. Cash is an asset. We increase the balance of cash by debiting it. So we are going to debit cash. And that's going to be for the $2,000. And we are going to credit an account service revenue. Service revenue is a revenue account. We increase the balance of a revenue account by crediting it. So we're going to go ahead and credit service revenue for $2,000. So that's what our journal entry would look like. For item B, it says issued a check for $500 for new equipment. Well, when we issue a check, that is going to reduce our cash balance. So that's a credit to cash. And when we purchase new equipment, equipment is an asset, and we increase the balance of equipment. So we're going to go ahead and debit equipment. So we will debit equipment for $500. And we're going to credit cash for $500. For the next one, it says, paid the monthly rent by issuing a check for $1,000. So again, by issuing a check, that means we're going to credit cash for $1,000. So I'll just do that here. And we have to figure out what we are going to debit. Now, this can get somewhat confusing because you have rent here. We are going to debit an account called rent expense. And the reason we're going to debit rent expense is because it's for the monthly rent. So that implies they're paying it on a monthly basis. If it said something to the extent that we were going to pay in advance or prepay, then we would debit a different account called prepaid rent. But because we're paying the monthly rent, we're going to use the account rent expense. Rent expense is an expense account. You increase the balance of an expense account by debiting it. So this makes sense then that we would debit it for $1,000. Next, it states rendered services for $1,500 on credit. Rendered is the same as performed. You may see this in your homework or your test or whatnot. I just wanted to point out two different words to mean the same thing. Sometimes this confuses students. So we've got rendered services for $1,500 on credit. Really, A and D are very similar. The difference is A was for cash and D is on credit. So we are going to credit the same account, the service revenue. So I know that I've got a credit for service revenue, and that's going to be for $1,500. Service revenue, that's a revenue account. We increase the balance of a revenue account by crediting it. We have a higher balance now than we did before, so that's why we're going to credit it. When we render the service on credit, that means that the customer now owes us the money. So we're going to use an account called accounts receivable. So we are going to debit accounts receivable. Accounts receivable is an asset account. We increase the balance of an asset account by debiting it. So that's $1,500. Next, it says collected $500 from a credit customer. Well, when we collect $500, that means we received cash. Cash is an asset. We increase the balance of cash by debiting it. So we're going to debit cash, the $500. And then we need to figure out what we are going to credit. So we're going to credit an account. We know it's going to be for $500. We just don't know what it is. Well, when we initially recorded the transaction, you can look in transaction D here. It says accounts receivable was debited. Accounts receivable represents the amount of money customers owe us. Some customer now paid us $500, so they owe us less. In order to decrease the balance of accounts receivable, we need to then credit accounts receivable for this $500. So we'll credit accounts receivable, $500. Next, it says we wrote a $120 check for the monthly utility bill. So here, if we wrote a check, that means we credit cash, $120, and we're going to use an account called utility expense. Utility expense is an expense account. We increase the balance of an expense account by debiting it. So we will debit our utility expense for the $120. And for G, it says paid a creditor by issuing a check for $600. So again, if we issued the check, that means that we paid cash. Cash is an asset. We decrease the balance of cash by crediting it. So we are going to credit cash, $600. And when we pay a creditor, that means that we owed the creditor money. And if we owed them money, that means that we had that amount represented in our books as a liability. The account that we typically use is accounts payable. So in order to decrease the balance of a liability or accounts payable, we need to debit accounts payable. So we're going to debit accounts payable by $600. And for item G, this is where it comes in handy. I'm just going to draw an arrow down here and kind of do a transaction. So this might be transaction 1. You might have purchased something, we could have purchased, say, supplies for $600, let's say. And when we purchased them on account. So that would be a credit then to accounts payable for $600. And then this is where G comes in. G comes in and says, okay, now we paid this off. So when we pay this off, we no longer owe the $600. So we need to debit accounts payable, the $600. And we're going to credit our cash. So a lot of times with accounting problems, they're going to give you this second step, and they're going to assume that you know this first step. So sometimes if you have to, just draw out that first journal entry to understand that second journal entry. So then the last problem states, purchase $2,000 worth of supplies on credit. And you can see I kind of already did that journal entry below right here, but we'll just go ahead and do it here anyway. So if we purchase supplies on credit, supplies is an asset. We increase the balance of an asset by debiting it. So that would be a debit to supplies. And that's $2,000. And then the other side of that transaction is a credit to accounts payable for the same $2,000. And again, we're going to credit accounts payable because accounts payable represents the amount that we owe to the creditor. Well, that's it for this episode. Make sure you give this video a thumbs up if you liked it. Ask your questions and leave comments if you have them. Subscribe to my channel for more financial accounting videos and ring the bell to be notified when new videos come out. Additionally, check out the link in the description for my website, passaccountingclass.com. It's a great resource for accounting and non-accounting students that need to pass their accounting class. It has more videos on similar topics, a message board where you can ask me your questions, and discounted rates for one-on-one tutoring with me. I tutor students across the U.S. using web conferencing tools, and I help my students succeed. I'm here to help, so if you have any questions, feel free to reach out. Thanks for watching.